Did you know the IRS actually wants real estate investors to pay less in taxes? Sounds crazy, I know, but the tax code was written in a way that allows real estate investors to make hundreds of thousands and even millions of dollars while legally paying little to no taxes. And here's the kicker. Even if you're a high income earner, you can still use real estate to slash your tax bill and build wealth at the same time. In this video, I'm going to break down exactly how real estate investors pay less in taxes, how to use the same strategies the wealthy do, and how to set yourself up to keep more of what you earn without breaking a single IRS rule. Let's go ahead and dive right in. All right, let's start with the worst way to make money, which is earned income. If you have a high-paying W-2 job or a business, the IRS sees you as their best friend, and here's why. Federal income tax can be as high as 37% if you're in the top tax bracket, and if you're self-employed or run a business, you pay the self-employment tax of 15.3% on top of that. Then you have state taxes, which can range from 5 to 13%, depending on where you live. So if you're a high income earner, you can easily be paying 40 to 50% of your income in taxes. But here's the secret. Wealthy people don't just build their wealth through earned income. They build it through assets like real estate, which has insane tax benefits that the IRS actually encourages you to use. Now let's talk about rental income. On the surface, it looks like rental income is taxed just like any other type of income, up to 37% in federal taxes. But here's where the magic happens. It's called depreciation. Depreciation is a tax deduction that allows you to write off a portion of your property's value each year, even though your property is actually going up in value. So let's say you have a $500,000 rental property and the IRS allows you to write off roughly $15,000 per year in depreciation. And then you also have $13,000 in net rental income after expenses. Now you think you'd pay taxes on that $13,000, right? Nope, depreciation completely wipes it out, making it look like you actually lost money on paper. And what's even crazier, you could still be putting $1,000 in your pocket every month while reporting a loss on your tax return. This also lowers your effective tax rate, which is the total taxes you pay divided by your income. So the more tax-free rental income you generate, the less you're actually paying in taxes. And this is why real estate is one of the most powerful tax shelters available, and it gets even better. Before we dive right into the next strategy, you might be wondering what happens to this $2,000 rental loss we have. Don't worry about that because I have a bonus tip at the end, so stick around so you don't miss it. But in the meantime, while your rental property is making you money tax-free, it's also increasing value or appreciating over time. And as you pay down your mortgage, your equity is growing. Now, what if you need to tap into this money? Well, of course, you could sell your property, but you're going to have to pay capital gains and depreciation recapture taxes, which is a tax hit you really don't want. Instead, you can do a cash out refinance or take a line of credit, giving you access to your equity tax-free without selling the property. That's right, this money is not taxable because it's a loan and loans are not taxable income. This is the same strategy billionaires use. For example, Elon Musk didn't sell his Tesla stock to buy Twitter, he borrowed against it. Real estate investors do the same thing, pulling out tax-free cash to reinvest and grow their portfolio or even just enjoy life. Now what happens when you actually need to sell your property and cash in on all that appreciation? Well, normally you'd owe capital gains taxes, which can range from 15 to 20% of your profits plus depreciation recapture and the net investment income tax, which can lead to even more taxes. But smart investors use the 1031 exchange, and the 1031 exchange allows you to sell your property and reinvest the profits into another property without paying any taxes. This means you can keep rolling your profits forward, upgrading to even bigger and better properties, all while deferring taxes indefinitely. And here's where things get really interesting. Let's say you built a massive real estate portfolio over your lifetime. If you were to sell everything today, you'd owe millions of dollars in taxes. But if you pass these properties down to your kids or your heirs, the tax bill literally disappears. And no, it's not a typo, it disappears. That's because of a tax provision called the step-up in basis. When you pass away, your heirs inherit the properties at their fair market value at the time of your death. For example, let's say you bought a property for $300,000 years ago and now it's worth $1 million. When you sell, you'd owe $700,000 in capital gains plus depreciation recapture. But if you pass it down to your heirs, the cost basis resets to $1 million, meaning they will pay zero taxes if they were to sell immediately. This is how generational wealth is built through real estate. But we're not finished. As promised, here's the bonus tip. That rental loss from before, well, it doesn't just disappear. In fact, thanks to bonus depreciation, rental losses are usually much larger, and it's actually possible to use them to offset your W-2 income or business income, resulting in up to 5 to 6 figures in tax savings if you qualify for one of the following: the special loss allowance, the real estate professional status, or the short-term rental loophole. If you want to know how these strategies work, I'll link up a video at the end of this one with more details. But what if you can't use any of these strategies? then this loss can offset other rental income from other properties or is carried forward to future years where it can offset future rental income or gains from the sale of other properties. As you can see, real estate is hands down one of the most tax-advantaged investments in America. You can use depreciation to shelter income from tax, you can access tax-free cash through cash-out refinancing, and you can defer capital gains and depreciation recapture with 1031 exchanges. You could pass down wealth tax-free to your heirs with the step-in basis, and you can even use rental losses to offset your W-2 and business income, resulting in significant tax savings. So if you're a high-income earner or business owner looking to build long-term wealth while slashing your tax bill, real estate is the answer. Now, if you want to learn more about how to optimize your real estate investments for taxes, go ahead and hit that like button, subscribe, and check out my other videos on real estate tax strategies here on the channel. Also, drop a comment and let me know what's your biggest tax takeaway from this video, and looking forward to seeing you in the next one.